21st, FOMC rate decision day. Thank you for joining BApig Live. And yeah, we've got an FOMC press conference coming up here in about 10 minutes. Thanks for joining, even though I was a little late today. Trying to get all the settings configured up for your ears and your eyeballs. But yeah, dog's back in the sesh here. We've got BApig mathematics that are going to be live on screen. I've got some Eurodollar futures that are not looking too appealing, or kind of less so from my normal chart setup. Let's get this Pink Floyd or this DMCA free music, as I should be saying, off. All right, so we're going to turn that off. And how are we looking with, okay. We've got a Powell news conference. We got some Tom Keene. Maybe I shouldn't play that Tom Keene just yet on the Bloomberg. I'll oftentimes have Bloomberg going, and I'll have me kind of going through the charts. But I'm going to keep things a little bit more simple. I'm going to try to going forward here. All right. Let's see how we're looking on stream. Bitrate, let's see here. Refresh that. Okay, all right, doesn't look too bad. Let's edit our stream info. U.S. Fed Reserve June meeting. Nope, we're in September now, so I'm updating our title. BApig 75 bips. I mean, from our last title, not too much has changed. All right, cool. Nice, Vox. Things are looking good on your end. I don't have my other monitor going right now, so I can't kind of keep things going. But I'm just going to go based off of Vox's and other viewers' feedback. All right, so we've got the Eurodollar futures. Eurodollar futures are ways for market participants to speculate on the future of LIBOR, London Interbank Offering Rate, which is kind of, I'm not too entirely sure about what exactly. It seems like it's like a survey amongst different banks at which they would lend money at, but yeah, Eurodollar futures. So I found a very cool feature. Being able to analyze these futures, because they obviously have different expirations, and the different expirations will have different values, and that will kind of show you where the market is looking for Eurodollar interest rates, which are some of the well, kind of provides the bridge between American markets and global markets. From what I know. But anyway, so this is just for me to look at interest rates and see which way the market is kind of anticipating for global interest rates, in a sense. So yeah, this future right here, as the price goes down, so you have the price right here on the right side, that means that the yield will be higher. So this is the current Eurodollar futures contract, so this would be for September, and that right there is showing us that 95.31, so you subtract 100 minus 95.31, and that gives us an interest rate for September about 4.7% on these London Interbank, on the LIBOR rate, really. So Eurodollar University has a ton of information about that, and I'll be definitely doing some study sessions where we just kind of learn more about the global economic system, really, and they do a great job of looking at those macro things. But that's not really what we do here. Really what we do is we look at short-term volatility expansions and contractions with a variety of different tools, and those tools all come from BApig. So if you want to, you can check out purchasing an indicator subscription. You don't need to in order to use the tools, but the way that I use them might be worthwhile. Anyway, Well, it definitely will be worthwhile. BApig has the best mathematics, hands down, from what I've seen on TradingView. There's nothing that's even close to any of this math, and not only on TradingView but also anywhere. And I say that with complete and utter confidence. All right, so let's make sure that I'm not dogging anybody out over here on Twitch. All right, so I'll turn up the volume. Thanks, Vox. You the man for that. Let's go over here, crank up the volume a bit. Yep, so that seems like that would be better for being able to hear me. And hopefully I didn't just put your ears into a headlock right there with my voice. But anyway, so Henry Hawk, we're back, baby. Back better than ever. And hope everything's going well with you over in across the pond, as they would say. I think that's just because people don't know the difference between the UK, Britain, and all those. But anyway, all right. So really, the reason why today I'm streaming is because we have the FOMC press conference with J Pow. That's definitely an interesting type of event going on there, but also the fact that we have, so basically today, looking at, so we've got 75 basis points increase, we've got J Pow, and we're just at one of the most interesting times to be a market participant in the past 20 or so, some odd years. I mean, it's always an interesting time, but this right here is this time in particular is one that is filled with volatility, and we can use a bunch of different indicators to be able to tell us about that volatility and about basically just leading us to make decisions that are rooted in mathematics, and being able to have a rationale, a mathematical rationale behind the decisions that we're making. And realistically, this is the way that I make decisions financially with this math, and instead of just kind of going off of gut feelings and connections and correlations that are really just not founded on math really at all. But yeah, so basically, why do I have all these indicators up on my screen? It's because I want to have a frame of reference, and I want to have multiple frames of reference to be able to make decisions in these financial markets that are handled by nanosecond algorithms or nanosecond bots, really, that just fill orders. But yeah, it's a tough, definitely a difficult type of trading back and forth. I don't really suggest it, but long-term asset accumulation and using different products to hedge exposure and that long-term asset accumulation, that's really the name of the game. All of this is inspired by BApig, and BApig is the genius behind really like this whole movement. And he was quoted as just basically saying, make a bunch of pools. So those are that's your basically look at your portfolio as one large pool, and then the returns for your portfolio. So you have this big pool, and it may not, when you start out, it's pretty dry, this pool, but then when the returns start coming in, that's your rain. And the rain is starting to fill up your portfolio and your pool, and those returns are what you're trying to keep, and you're just trying to make sure that if that when a drought comes, i.e. negative returns or negative drift, that there's that you have ways to be able to keep the rain flowing and keep those returns. Anyway, So let's get over to the press conference. I don't like. It's not like I'm trading off of this, but it's just interesting for someone who's in on this. And I think you can probably already hear it. I hope so, but maybe no, you can't. Okay.
With demand for workers substantially.
So we got a 2-year yield at 4.07%. We've got a 10-year yield at 3.56%. So that's inversion right there. That's yield curve inversion on the
FOMC participants expect supply and demand
on the U.S. Treasury yield curve.
Balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%.
And that inversion on the U.S. Treasury yield curve is one that's when it stays inverted, it's significant.
Range of goods and services.
Sorry about that.
Although gasoline prices
want to be able to have you guys listen to this.
They remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%. And we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Hey, Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year, and historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect. Because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer-run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick. Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases, but there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply-side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply-side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025? and yet the dot plot projects cuts as early as 2024. And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you have to, you can't really, you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thank you, Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus, and you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, And that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion. And this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it's very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control, and that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now, and get this job done, and keep at it until it's done.
Nicole from CNN.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely. What you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can pick, and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. the path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Chairman Pow, wrapping things up early. I had to rush to grab the microphone just then, TK. I think the message here, if you've got more questions, see my speech in Jackson Hole, Wyoming.
I think that would be true.
For more.
Rinse, repeat.
There we go. Rich Clowder alongside us, the former Vice Chair of the Federal Reserve. I want to whip through the price action to get you started. Big turnaround. Going into this, deeply negative, then positive for a while. The Nasdaq was up about 1%. It's now up 0.1%. We fade that in the last 10 minutes or so. We're down about 0.1% on the S&P 500. Yields at the front end were higher by more than 10 basis points.
All
now
over
up
the
just
place.
5. Now up just 5 on a 2-year, 4% on a 10-year, 353. We're down about 4 basis points. We talked about that dollar strength. It sticks. Sterling 113.20, negative 0.5%. This dollar a whole lot stronger. Chairman Powell telling you pretty clearly they're in it for the long haul. Take a listen to what the chairman had to say.
What we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Rich, you know how this works. I've already had the messages. This was it. This was peak hawkishness. Doesn't get any more hawkish than this. What's your response to that?
Well, I think, as Lisa said, it was a hawkish 75.
Yeah.
They didn't do the 100, but in some ways I think it was more hawkish because it shows a committee resolved to move into restrictive territory, keep at it till the job is done, compelling evidence on inflation. And near the end, Chair Powell said, and it will be enough in terms of the rate hikes. So instead of getting into what the dots are saying, he said, it will be enough. And I think that's the first time he's actually used that phrase. So
what's important here, Lisa, is the body language of the former vice chairman when he agreed with Chairman Powell and what he was saying. There was a very physical response.
Do you think we needed a clarity?
From Mr. Clarida.
Oh my God!
So we need,
I got to watch the body language.
Like we have a Bramo cam. I think we need a clarity.
I've already had the messages though, Lisa. It will be enough is the new whatever it takes.
Yeah. Well, and what will it take? Will it take another 75 basis points the next meeting, Rich?
I think so. I mean, if you do the arithmetic, the dots, and I think pay attention to the dots at least for this year, show another 125, and you do 75.50 as it looks like the path of least resistance right now.
Does it make sense to you that the market rallied after this?
You know, I've noticed this year some of the press conferences, I think, that skew hawkish. The markets, especially the stock markets, love it. So maybe I'll have a good answer tomorrow when I see where it settles down. But you know, Chair Powell is getting good at these, so yes.
Rich, can you tell me how you respond to that though? When you've all had this meeting, the chairman's done exactly what you expected him to do in the news conference. For you all sitting in the committee, it sounds very hawkish. You come out and you see the Nasdaq up 0.7, the S&P up 0.5%. Does that matter to any of you? Do you look at the end of the day prices?
Well, I did.
That's meaningful.
I mean, I won't speak for my other former colleagues. I did. What I oftentimes found is I more or less understood the bond market reaction in the 30 minutes after the announcement. I only was batting about a 50% coin flipped on the equity market reaction. So I think there's a little bit of cross-market churning on statement day.
The reason we ask this is because I think that Neil Kashkari, the Minneapolis Fed president, speaking to our colleagues Tracy Alloway and Joe Weisenthal on their podcast, Odd Lots, he was pretty clear about where he wanted this market to be, how he wanted financial conditions to respond. That's not new, but do you think there is more of a focus on that this time around?
Yes, and as I mentioned, I think coming out of the July meeting, which some, not I, took as being a dovish pivot, which did not happen, you did see Neil, President Kashkari and President Daley really pushing back on this idea that the Fed would hike this year and then immediately next year start to cut. And you definitely saw Chair Powell pushing back on that again today.
I've got two questions. One of them is very general and the other sort of bow tie baloney. The first one is there too much communication? You and I remember Columbia's Arthur Burns. We'd look at the smoke signals.
Yeah.
Then we had to worry about what lunch Chairman Greenspan had in his briefcase. And now we have just overt communication. I would say you were actually fairly quiet compared to some of the presidents and such. Do we have too much are we drowning in Fed communication?
Well, what I would say is I think it's valuable for the chair to do the press conferences, and also he's up there doing testimony around the clock. So yes, but in terms of signal to noise, I think you do think about that in terms of different points in the cycle. I wouldn't necessarily want to characterize it. Now, what I would say definitively from my view is the hawkish pivot we've seen since the March meeting is remarkable because you'd have to go back decades to when we were starting our career to see a similar pivot without all that communication. And I think it's worked so far in the sense that we've had the tightening in financial conditions relatively orderly. And in a way, as you say, on press conference day markets go up, we've had it because the chair has been willing to own the guidance. And as long as the chair owns the guidance in the press conferences and the like, that can enable some of the noise to be filtered out. I think where it gets challenging is when you have a lot of noise and the chair is not owning the message. But Jay Powell's owning this message and owning this guidance.
I want to go to early in the press conference. Not once, but twice it came up, this Clarida-like word, nonlinear. And of course, this is your meat and potatoes with Gertler and Galley and the rest of it. Fernandez Villaverde at Penn is excellent on this. He's got 38-page slides of nonlinearity, and the summary of it from your mortals like me is we're more blind when we're nonlinear than our fancy, simple, linear models. How blind is this Fed forward if we assume we're going to get nonlinear conditions, kinks, jump conditions, surprises along the way?
Yeah. So excellent point. I've not read that paper, but the general proposition is a lot of modeling, including my work with Gertler and Galley, usually linearizes those nonlinear models, and so you simplify the analysis. But where I think it is relevant, Tom, in this environment is the labor market and the pandemic shock and the reopening are such a Six Sigma event that whatever the old normal was pre-pandemic we're not there yet. And so in some ways, I think the Fed and other central banks are sort of navigating their way. And that's why Chair Powell will say things like, inflation's too high, or we want inflation to be lower. They're trying to simplify a very complex environment. And I think also, Tom, because it's nonlinear, probably less model reliant than in the past.
Do we risk giving the American public, and particularly the middle class, a Six Sigma labor event, a Six Sigma standard of living event where we put them flat on their back?
Well, I hope not, and I think we can avoid it because, as I said, inflation expectations now are reasonably well behaved. That means that the Fed has less heavy lifting to do than Paul Volcker did, but there's no doubt that the economy is now out of balance, and it's been quite a long time since it's been out of balance, and right now the Fed is the game in town that's trying to push against that.
When it comes to our good friend Mike McKee, the chairman is often a bit evasive. I don't know if you've got any inside information on as to why, but he asked a little question about how will you know if you've done too much? How do you think they will know?
Well, as I tried to suggest in the earlier segment, I think that is a real risk in this cycle because the luxury of the pre-pandemic, the Greenspan, Bernanke, Yellen, and Powell term one, which I served with the team, was because inflation had been so low and stable and globalization and all of that, the Fed had the luxury of being very nimble to cut rates when unemployment ran up and to hike rates when unemployment went down. And I think that the challenge right now is because inflation is high and persistent, that the risk is skewed to doing too much. But because of the nonlinearities and other things you all have mentioned, they really can't afford to declare victory. They can't say mission accomplished and then 6 months later have inflation pick up again. And I think Chair Powell and the group is really trying to protect the institutional integrity of the Fed. And I think the risk there will be doing too much.
Mike McKee ran out of that news conference, got to the camera. He joins us right now. Mike, I sense you weren't satisfied with your response from the Fed chair in that news conference.
Well, he's not going to use the recession word, even though I goaded him to do that because that would make its own headlines. But he is pretty clear that the Fed is anticipating a recession and that it is going to send the unemployment rate higher. You notice over the last couple of meetings, he's gone from soft landing to softish landing to now some pain. There is a definite tilt towards an economic contraction coming here. And I think he's trying to prepare prepare the markets for it. Whether he's doing a really good job of preparing the American people for it is another question.
And Rich, this really goes to the question of why markets still believe there will be a pivot. And you're still getting commentary. Let's see what the Fed really does when the unemployment rate actually rises, when they get political pushback. And there are going to be notes saying, no way are they going to allow this. What's your response?
My response would be the committee is surprisingly unified on this point in rhetoric and in their projections. Secondly, I understand why markets are doing that, because if you just ran a regression of the Fed under Greenspan, Bernanke, Yellen, and Powell, it would basically reflect that view that the Fed's very sensitive to the unemployment rate. They can't afford to do that now as long as inflation in the labor market is overheated. So at least until inflation comes down compellingly, as the chair said, I think you want to fade that dovish pivot sentiment.
Lisa's sort of sneaking in the politics here, and I think we've got to pick up on this.
Yeah.
Senator Warren, during this news conference, tweeted out the following: the Chairman Powell just announced another extreme interest rate hike while forecasting higher unemployment. I've been warning that Chair Powell's Fed would throw millions of Americans out of work, and I fear he's already on the path to doing so. The November decision, as you're well aware, is within a week of the midterms. How would you respond to the politics on the horizon to all of this, Rich, and what's forming right now already?
Well, what's forming now is obviously, and there's more to come, given the pain that the chair refers to, and these projections. I think by putting by emphasizing, not only running down the dots, but by putting the projections out there and really embracing them, as the chair did today, I think that the committee will try to tee up 75 as the expectation, and I think that's what they have to do. So,
do you worry about this institution though becoming a political football once unemployment starts to climb?
I worry about it, but as a student of monetary history, it's not unheard of. I mean, Chair Volcker dealt with that, as he wrote about in his memoirs and others. And so I think that one of the consequences of the inflation overshoot is that it's going to trigger that pressure. But I think the institution will survive it.
Did you basically hear Fed Chair Jay Powell say that the chances of a soft landing are almost non-existent, and that we're heading toward a recession, and the question is just how deep it's going to be?
I think the way, Lisa, he answered that question is that the Fed sees below-trend growth for several years.
How do you translate that?
And I think historically, with that rise in the unemployment rate, I don't think we've ever had a cycle with a 1 percentage point rise in the unemployment rate, which has not been declared a recession by the NBER. I don't think the Fed chair needs to get into using that language, but essentially they're engineering what we used to call a growth recession at minimum. And I think you're right. I think you have the transcripts available, but I do think earlier in the year when he got similar questions, he would talk about the hope for I think I used to call it a softish landing, and I think we got less of that today.
It's the reality of it all, Rich. Finally talking about the pain that we need to go through, and that really started, Tom, with the Jackson Hole speech, I think, in a more profound way.
Yeah, and John, you've been on this where you've carried forward the idea that it's a continuation of Jackson Hole. There's a group of people, arch-qualified, people that have done work like you. I'm going to pick on David Blanchflower up at Dartmouth with work at Bank of England, and of course his classic, The Wage Curve, who say, look, we're conflating here the financialization or the monetary policy solutions to our post-pandemic challenges with just public policy of saying it's okay to recover and to be calmer about inflation and not try to get to this Taylor-like rule of 2%, but move it higher. Adam Posen says 3%. Blanchard stalked post-crisis of 4% with Stiglitz. Why are we wedded to 2.0% is the bogey?
The short answer is New Zealand. So New Zealand was the first country to formally target inflation, and they picked the number 2. And it's only half in jest. There was nothing magic about 2 versus 2.5 or 3. Where I do think this could end up in a couple of years is the Fed does get inflation down into the 2s. Call it the 2 point something.
Top line inflation.
PCE inflation, but headline PCE inflation is in the 2s. And in that environment, I could well see the Fed on an extended pause or perhaps even beginning some modest cuts and not really doing the heavy lifting that their models will say they would need to do to bring it down from 2.8 to 2. And then that will tee up the next review of the Fed's framework, which the chair has indicated will commence in 2024 and complete in 2025. And the Fed could well, in that review, consider raising the inflation target. Now, interestingly enough, the chair was asked that specific question in the spring. Would you support raising the inflation target to 3? And he gave a 2-letter answer, no. So
that is the codification of that's the entrenched institutional mantra right now. Explain to me the ramification to our viewers and listeners of moving from 2.0 to 2.1, hedge it down, make Adam Posen angry, 2.8% and not 3. What would happen to us?
Well, it would be path dependent depending on how we got there. But under a lot of scenarios, very little would happen. I mean, the 2.5 would become the new normal in economic recoveries and expansions. And if you had a recession, it would dip down below that. So I think it depends on how you get there. Maybe a little context is useful. So when I participated in the review that we did in 2019 and 2020, we actually took raising the inflation target off the table. And the reason why we did so is, we felt it would be difficult to get consensus on the committee at that time, since the challenge historically for the Fed inflation had been below 2%. So we thought you don't really solve that problem by declaring 3 or 4. But the circumstances under which the next review will be undertaken will be different. So they could consider that.
Don't you think it would be harder to anchor inflation expectations if you start to wobble under existing mandate?
Well, and that will be the pushback, certainly. But I'm merely saying that this is something, especially the committee is a different composition than it did than the committee on which I served. And so it's certainly something that could be on the table.
Already getting some upgrades to the forecast. This from Mike Gapin at Bank of America moments ago. We now expect hikes of 75 basis points in November, 50 basis points in December, followed by 2 25 basis point rate hikes by March of next year. They go on to say our new terminal target range is 4.75 to 5%, up from 4 to 4.25% previously. It's amazing to me and everyone else, and Lisa, you included, just how much this has changed and how quickly it's changed. In the last week, I think it was just last week, 1 week ago, Matt Lazzetti of Deutsche Bank came out and said, I think Fed funds close to 5. Sounded like an interesting number at the time, maybe a little bit of an outlier. Market was at 4.5. Everybody's gravitating towards that kind of world.
And it's kind of amazing, given that we haven't seen more of a disruption. We are seeing now markets reverse, stocks now down. We are seeing yields higher. You look like, okay, finally they're sort of hearing the message,
I'm sitting there thinking you're going to be busy if you keep trying to do this, because we were up, we were down,
I know. We're whipsawing around as we try to understand the ramifications. When do you expect to really, Rich, feel the pain? Right, to start seeing the unemployment rate rise. And I say this, as Neil Dutta put out there on Twitter, the faster the unemployment rate rises, the better for risk assets in this perverse way, because the closer to the Fed's goal.
Well, the Fed goal ultimately, though, is to bring down inflation. And so the real wild card in this is the first step is slowing demand, so you see the rise in unemployment. The second is how quickly does that translate into declines in inflation. And so I think there are a lot of steps along the way. I take the chair at his word. I think they want compelling evidence, and I think that unfortunately it's going to require compelling evidence of pain not only in economic growth but in the labor market. And I think that, as I said, the pre-pandemic Fed had the luxury of being very nimble with regards to adjusting rates to unemployment, and I just don't think that they think they have that option, at least for the next year.
And Mike, it's the hawk on repeat at the moment. Mike McKee, that line he used, it will be enough. We will keep at it until the job is done.
Yeah, and that raises the question of how much faith we should put in these projections of the dot plot. And I will ask Rich, because he participated in this. When you look at 4.4% next year, you have to round that up. They're really saying 4.5 because of the effective rate. And you had 6 people at 4.4, and you have 6 people at almost 5. They're pretty evenly divided. What are the chances chance that, let me put it this way, are the chances greater that we go to 5 than we go under 4.4?
I think so, because I just think that's the initial conditions on inflation and on the economy. And so, yes, I don't think it's an even bet there. I think the skew is going to be hawkish, and I think President Bullard and others have made this point, Jim, more directly than some others. I do think that now the view is what we're seeing is that they have a sense of where they want to end up, not precisely, and they want to front load as much as they can for a variety of reasons, including the fact that doing this now is more straightforward to pull off when the labor market is still printing 300,000 jobs and the unemployment rate is still low, and the cost of delay could be very substantial. So I do think that you do have a broad sense of getting this done, getting where they think they need to get by early next year.
They've done a lot already. 3 percentage points of hiking in 6 months.
Yeah.
Didn't even do this in 3 years the last time around. If you are just tuning in on TV and radio, reacting to the Fed decision and Chairman Pow news conference, this is Bloomberg Surveillance, a special where Lisa, Tom and I stay a little bit later. Some of you are happy with that. I'm sure some of you aren't, but tough. Your equity market is down by about 0.9% on the S&P 500. On the NASDAQ, we're down about 0.85%. Lisa and I were talking about this. This equity market has been all over the place. If you're looking at the bond market, at the front end, yields were much higher. They're up by 7 basis points now, 4.03%. It's a 75 basis point hike, and we've gone through the forecast a few times. I can do it again for you without just giving you all the numbers. The GDP forecast revised lower for 2022, for 2023, likewise for 2024. The unemployment rate kicked higher, and the dot plot kicked higher in a material way as well, off the back of, let's just say, a more constructive inflation forecast relative to the aspiration maybe of a few months ago. Do you want to let me finish just quickly?
Go ahead, yeah, Gary, carry on.
Fed funds and where they think it's going to be. I'll squeeze that in. 4.6% for 2023. 2022, they've got it at 4.4%.
Can I just say, why is it that the market thinks that this is more dovish than raising rates by 100 basis points and then 50 basis points the next meeting, which is basically what's being priced in?
I've got no idea.
That's all I want to ask.
I'm not sure if it's even dovish right now, though. I mean, what are we down? We're down by 1% there and thereabouts. Yields up at the front end. If it stays here. Once again, we did this the last time the Fed met. I don't think you can define, Tom, any given meeting by the intraday price action on the S&P 500.
I strongly support that.
The Chairman Pow was
back and forth.
It's unanimous.
Chairman Pow was pretty clear, Rich, and I think we can all agree. This is a guy who wants to get things to a sufficiently restrictive stance, thinks we're a ways away from there at the moment, so they've got more work to do. And once they get there, they want to keep it there. They want to maintain that stance and have clear evidence that inflation is on its way back down to 2%. And that sounds like a story for the end of 2023, never mind the end of 2022.
Very quickly here, John, as we get to Jeff Rosenberg with BlackRock, across the arch of our debt, which is a price, which is yield, the twos as compared to the 30-year bond, the 2-year note compared to the 30-year bond is to new substantial inversion of a negative 55 basis points.
Down 12 basis points, just today, by the way, on Tuesday.
This speaks volumes. We can get interpretation of that as Richard Clarida stays with us. With Jeffrey Rosenberg, he's Senior Portfolio Manager at BlackRock. Jeff Rosenberg, what does the different spreads in full faith and credit tell us now? The 2s10 spread, negative 53 basis points, and the 2s30 is unspeakable. What do they say to us?
Well, the big thing they say to us is that a lot of what we just heard is reflected in that front end of the curve. You know, we saw a 50 basis point increase effectively from the release of the the August CPI earlier this month. And effectively, the Fed raised 50 basis points in terms of how much they were going to increase their tightening. And that's fully reflected now in the front end of the curve. So you're getting a lot of the kind of expected path. That was what was new today. What was new was a little bit higher, a little bit more front loaded. What's the same story is the Fed doesn't have to do very much to the economy, to unemployment, to get a spectacular decline in inflation. So that story is the same. The other thing here, Tom, is TIA. There is an alternative, and that's the front end in yields. You know, they reflect most of what the Fed is expected to do. If that forecast is correct here. A lot of the pain in terms of bonds is behind us, and so that gives investors a real alternative.
Jeff Rosenberg, you were weaned at Carnegie Mellon with Alan Meltzer, Marvin Goodfriend, and all, and the mathematics of Carnegie Mellon. Off the back end of every equation is a Greek symbol, epsilon, which is the uncertainty that's out there. How uncertain is your fixed income investment path forward?
Yeah, that's what I was referring to in terms of what's not new here is this essential implicit consensus view on the ability of inflation with this amount of policy restriction to have a spectacular decline. And he got the question on that inflationary forecast, and he kind of outlined, what needs to happen in order for that inflation decline to occur. But that is the essence of the uncertainty here, Tom. And what's remarkable is we keep getting that wrong. We keep being surprised at how durable inflation is, yet our expectations and what's priced into markets, what's priced into that back end of the curve, to your first question, is a very strong view that inflation will come down along that path, and therefore you don't need a big inflation risk premium. That's the uncertainty. That uncertainty is not being resolved here today from the
I'd throw in another thing we're getting wrong as well, Jeff. We're getting that wrong. And we're also getting wrong this idea that we can test the Fed's resolve and have this idea of a pivot every 6 weeks or so. What did you make of the nod to Draghi? I pulled up the speech from July 2012, and it wasn't just the whatever it takes. It was the final line Draghi used after that, and believe me, it will be enough. And then Chairman Powell, it will be enough. Jeff, what did you make of that?
Yeah, it's a very different context. And in some sense, I think, there's a real question here about whether or not that is right, whether this will be enough, because, there is a whole other viewpoint out there. It's Summers, it's Jason Furman, it's other folks, talking about how this is still somewhat very unrealistic economic projections coming from the FOMC. When you look at those SEP projections, that another view of the strength in the labor market suggests that you need to have much, much more restrictive policy for much longer. So it will be enough is probably not the conclusion I think a lot of folks would draw, given the strength of the labor market and the resilience in the economy to obviously it's a lag here and we haven't had enough tightening. But it also points to the potential that there may need to be a lot more in terms of policy. That's clearly not in market expectations, nor in the Fed's forecasts. So that's the other side.
Well, Rich, you noted that. You actually raised your eyebrows when we heard that from Fed Chair Jay Powell. It will be enough. What was the significance of that to you?
Well, I want to go back and look at the transcript, but as I recall, the way he answered the question was to discuss whether or not the dots would be enough that were showing the rate hikes penciled in. And I heard him to say, but again, I want to look at the transcript, but right now, don't look at the dots. I'm telling you what we will do will be enough. Not that the dots will be enough, but what we will do will be enough. And so in that sense, I think it was maybe closer to the Draghi-esque unconditional commitment, not to any particular destination for rates, but to succeeding and as Paul Volcker said, to keep at it till the job is done.
So, Jeff, from your perspective, how far away is the market from realizing this conviction of Fed Chair Jay Powell today that he will do what it takes?
Well, I think with respect to the expectation that inflation will fall and will fall quite dramatically with what is priced into that dot plot to those median estimates, the market is there. But it's important to remember that the FOMC's projections can be wrong. The market can be wrong. So we are pricing in a consensus view and a path for inflation that is basically at the end of 23 back down to pre-COVID 2% levels with a 4.4% peak unemployment rate. So if that indeed turns out to be the case, then the market is reflecting those expectations. But there is, the possibility, and to Tom's question, I think a lot more uncertainty should be expected around that outcome actually being realized.
Hey, Jeff, thanks for completing just a fantastic lineup for us on Fed Decision Day. We appreciate it, sir. Jeff Rosenberg there of
Thank you.
BlackRock. A final thought now with Rich Clarida. Rich, I saw a tweet a little bit earlier as this news conference was going, and it said, you want the bad news? The quiet period's over. The Fed speakers are going to start coming out now. Can you tell me, as someone who was on the board, when you see the regional Fed presidents starting to muddy the message a little bit, how does one feel on the committee when that starts to happen?
Well, I mean, I'll be very diplomatic. I had regard and respect for all of my colleagues and learned a lot from them. I think this is the world. ECB is the same way. You can't put the genie back in the bottle where there's the one voice. And so I think it's fun. As I tried to mention a moment ago, so far the Fed has pulled off a remarkable hawkish pivot because the chair has been willing to own the guidance. Where we get into tricky territory will be if the chair steps back from owning the guidance, and then you've got 18 different opinions about the destination for rates. But right now, this is not only is it Jay Powell's Fed as chair, but he is owning this message and using every press conference and every speech to hone the message.
One of the great pieces is Ken Rogoff's tribute to Rudy Dornbush at the IMF a million years ago. It is just a superb exercise in a tragic early death. The fact of the matter is, right now, pound sterling is having a tragic and early death. Tomorrow, the governor of the Bank of England has to staunch sterling 112.89. Forget about John Connolly. I'm suggesting that's Jerome Powell's problem.
Well, because it's not just the UK. There are probably 40 or 50 other exchange rates that are moving by similar amounts in similar directions. I think, as I alluded to in the earlier segment, what can go wrong? Well, obviously a lot of things can go wrong, but it may not be the U.S. financial system. It may be collateral damage globally in a strong dollar period. And then you, of course, on top of this, you have whatever the heck is going to happen in Ukraine and China. There's enough. There's enough going on right now.
You're free at 6 a.m. tomorrow?
Well, it depends.
You could just say
That's what I say, and it never works.
Rich, this was awesome.
Yeah.
Thank you, sir.
Well, what's your calendar look like November 2nd?
Yeah. Consider it done. No, it's been too long, folks, and so
we'll make it happen.
Tom Keene, Booker.
There we go.
It's a new job.
Career team, Richard Clarida there, the former Fed Vice Chair, and so much more. Thank you, sir. We appreciate it. Counting it down to the close now. We're down about 1 full percentage point on the S&P 500. I'm pleased to say Romain and the team will do just that. Romain joined us now. Hey, Romain.
Hey, yeah, we're going to be pushing ahead, of course, to Bank of England, the Bank of Japan, and, of course, the Swiss National Bank. The last in Europe still clinging to negative rates. Jason England over at Janice Henderson going to be stopping by the close to give us that global view. We're also going to be talking to Rob Waldner over at Invesco, the chief of...
All right, that was enough feenance for the day. Definitely got more in than we usually do. But thanks for joining BApig Live, Random Walk with BApig. And we can get into some charts here. The reasoning behind listening to that kind of jargon is just to be able to be on top of things, just to be able to get into the type of mindset of is there restrictive monetary policy going on? Is there accommodative monetary policy going on? And just in the scheme of kind of just being able to maybe get onto some trades, knowing what's going on in across markets. Am I going to make actionable decisions based off of that? Based off of those types of things? No, definitely not. I'm going to make actionable decisions off of what I'm seeing here. What I can do is I can simplify things just a little bit here, is making it 3-pane. And I can show you what I've got going on here. I've got a volatility panel right over here on the left with a monthly expected move. Or actually, that's a 2-day expected move. My apologies. That's a 2-day expected move. And all of these blue lines right here are all the first standard deviation, so 32% probabilities. So in between these lines right here, you will see 68% of outcomes. So for this week right here, right, this is a weekly, that's a weekly expected move. So 68% of values will fall between 11,860 and 12,080 according to the BApig expected move. And that's on a closing basis. So making sure that we know that that's closing prices. But so these are returns-based metrics, and when we look for so the way that I would time something up maybe is if I saw a low volatility read on the Nasdaq, let's say like something like this right here before the meeting, then I would maybe check over here, and then I'd say, okay, are conditions suitable for volatility expansion? And if the conditions are suitable for volatility expansion, then how do I want to play that? How do I want to express that bias? Do I want to sell calls? Do I want to short futures? Do I want to buy puts? Do I want to short stock? I don't want to short stock really ever, but just kind of being able to work through those. So like a 2-hour time frame. I don't know if maybe I'll be trading a 2-hour time frame pre FOMC meeting or something like that. But I'm not usually trading that. I'm trading like the 6-hour, 4-hour daily, and I'm not even really trading all that often. Sometimes I've got some paper trading accounts. I've got my actual account but I'm not looking to like with my whole with my actual money. I'm not looking to make a bunch of high frequency types of trades. I'm looking more so to use that capital to find opportune entry points and be able to find potential exit points if I end up making enough on the trade, but more so it's just to be able to find opportunities, and that's really and then really being able to use different products and be able to find those points where things where the math is in your favor as a market participant. So you'll see me sometimes. I'll go in on the 2-hour. I'll go in the 4-hour. I'll look for a daily vol expansion, and those are times where it's going to be based off the math, of course. But then I might be looking for something with that might occur at the same time, like a GDP report or something like that. But that's more speculative. That's not what this is about. What this is about the math. And you can get some narrative too, and some market dynamics. But really, what this is looking for is like the reason why I put that in like that Bloomberg segment is because I'm not trying to find the bottom, but I'm just looking for, is there any substantial change in policy that I should be aware about, and that occurs almost never. It's the policy is not going to change very quickly, but you might be able to see something occurring that may not be making too much sense. But realistically, I'm just trying to look for when will there be a top in rates? When do we see rates starting to fall? Which might be a good time to free up some delta or add some delta. Add some shares of some growth stocks, of some triple Q, of some getting some exposure onto some Bitcoin, to some Ethereum, and just be able to add on some risk to the portfolio. But with these macroeconomic occurrences, it's just gonna be it's just a that's another part of it. But I mean, you don't even really. What I'm trying to say is really you don't need to pay too much attention to the mainstream or the financial narratives, or the reason why today is down 2% on the Nasdaq, or those types of things will be explained with the math, but it's like those mainstream types of things. I mean, like the fixed income space and learning that. It's definitely there's definitely, I mean, yield, like looking at futures curves and stuff like that. We can go into that too and look at that, because the futures curves are really they're a great tool to be able to look out and say, okay, what is this market projecting? Where in the future, where in the future is this market going to be from everything we know today? And so yeah, we can go check out what I was doing. I was just pulling up like a Eurodollar futures curve. What I was doing was just, okay, so I was comparing today's Eurodollar future. So this is for GEZ 2022. That's when the Eurodollar is the LIBOR futures market will close on December, third week of December, I think. But anyway, so it's saying, okay, 95.32. So today, the market thinks that Eurodollar futures are going to yield roughly about 4.68%. And so when this price goes down, that means that yields are going up. So your risk-free rate is essentially increasing. So when that risk-free rate is increasing, then assets that are not that don't earn interest, there's a possibility that they're going to take a hit. But at the same time, though, there's this whole the whole market has kind of changed in a sense of monetary policy. So monetary policy has changed incredibly in the past year. They were a bunch of doves. They were talking about how inflation is low and we're trying to get inflation up. And we're talking about doing this easing stuff and all this convoluted bullshit that it's very difficult to be able to get a straight answer as far as what's going on here. Because in finance, there's very, very few one-for-one causations. Like there's very few, like people are saying, oh, interest rates going up, that's why asset prices are falling. And that's another relationship where, yes, there is a relationship between the risk-free rate and asset prices. But what's that relationship? Well, I can go over here and I can go, okay, let me see. Let's go mutual information. But I don't even really need this this tool. I mean, this tool is great. Don't get me wrong. This is some of the most advanced mathematical concepts coded that I've seen. Really, I mean, nobody's even close to this. Mutual information. Look into that. That's a topic that's incredibly cool. But anyway, it's that in finance you have all these people talking about these relationships and these correlations. So they're trying to say, oh, because the VIX went lower, well, the S&P is going to go higher. That's more of a direct relationship. But they start talking about GDP and its effect on the S&P 500. They start talking about oil and its effect on the S&P 500. And don't fall down that trap. Don't fall down that trap because the market that you're trading is the market that you're trading. And the only thing that's going to affect its price, the only thing that's going to move its price is buying and selling. I mean, there could be an article that comes out that says the world's going to end tomorrow. But if people don't buy and sell off of that, then you're not going to get a change in the price. So the change in the price is big because that leads us to our returns, and our returns are going to be much less random than something that's getting quoted in real time about a bid and an ask, which is price. So yeah, kind of that's my rationale for putting on Bloomberg. Sometimes it just primes up the brain, and it allows you to see different assets, different products to trade, and it just kind of gets your mind going like that. And then also you can kind of hear about what what financial media is looking at with these FOMC press conferences and stuff like that. And Powell came out today. And said that he came out hawkish. We're gonna bring the rate increases, and for Powell, he almost has to be hawkish, but this is another correlation that it's just not even so. You have to think to yourself, why are there interest rate increases? Why are they raising rates? And when we think about that, they're raising rates because of CPI, right? And this is CPI, I guess, right? CPIA or CPI, CPI US. Food in U.S. cities. No, it's CPI. I think it's CPIA for all items. Okay, yeah. So this is CPIA or whatever, and the fact that they're okay. So this is the price of goods in America, and they're increasing interest rates because the price of goods in America is too high, and around the world it's too high. So we're gonna raise rates, and it's just another kind of erroneous correlation. It's the correlation between interest rates and consumer goods price inflation. So we're going to increase the overnight yield, and that's going to it's like a snowball effect or trickle down economics, or it's okay. So then it's just going to gain steam, and it's eventually going to we're going to see an impact in the price of crude oil, or the price of really natural gas or whatever. Number one, it's never going to be a 1-for-1 causation. You're just not going to get that maybe VIX S&P relationship, but that's still not 1-for-1. So you have in finance, it's this is the best example of it going on right now. We have this huge correlation right now between yields, so U.S. Treasury yields, and the correlation between that and consumer prices. So the price of orange juice, the price of your groceries, the price of your the price of your gasoline, the price of your heating your home, the price of all these different things put into this table and then spit out into this figure that's CPIA or whatever, and if that's supposed to be cured, or the price of goods are supposed to decrease because of a U.S. Treasury yield hitting 3.25%. Even just at base level, that just doesn't make sense. But we could do the 30-day Fed funds versus CPIA. Maybe we can even do PCE. PCE is just the core expenditures, I guess, but we'll do CPI. But these indicators are incredible. They really are next level. But if you don't have the perspective, the mathematical, the entropic, the ephemeral nature of markets, then they won't do you as much good. So definitely having that. Having some type of if the Fed's looking to raise rates here, what does that effect have on different assets? But okay, so how can we? Let's see. so mutual information. I mean, that's kind of a next level indicator that I don't know how much is going to really help. I hope I haven't been. I think what I've been doing here. So I've been keeping my other audio on. Yeah, but nothing's playing. Whatever. But so mutual information is measuring two variables and how dependent they are on each other. So with that, there's a, I mean, you can look at different things that people love talking about, like so 30-day Fed funds futures, and let's see what can we drum up here with 30-day Fed funds futures. Realistically, what I was looking for is looking to do some type of CPI analysis, but I don't know. I think it gets calculated at the end of the day, so it's not going to work like that. But all those correlations in finance, all those types of long dollar, short crude oil, or long crude, long dollar. Like there are some spread trades that you can do that will help lay off some risk. And I'm not against spread trading or anything like that, but I just think that there's a lot of rhetoric that's just bullshit, and I don't want to be a part of that bullshit rhetoric. So I'm going to try my best not to say anything that's not supported with empirical evidence, and empirical evidence is through research, stats, figures, and all that. So definitely try to do that. But all right. Anyway, so we got our 30 days, and this will be something that we can look into too. But so this is your euro dollar futures contract. So like those types of things, knowing what a futures is, a future, knowing what an option is, there's videos everywhere for that. So definitely brush up on that type of knowledge. And if there's stuff that you want to look at, ask away in the Discord, ask away over here on Twitch. But yeah, so the reason why we looked at that Bloomberg and looked at the whole press conference, it's not to find trades, or it's really, just more for entertainment and being able to know where J Pow is saying he is. But like that, it's all smoke and mirrors, really. I don't know how much of it is really 100% believable anyway, but it's just to know, okay, Fed's still saying they're restrictive. And then we can look in and say, okay, are there any futures? Are there any future dates where interest rates are actually falling? If so you have interest rates that are decreasing. So the risk-free rate is going down when the Fed is saying that they're going to increase rates. Well, we can go over to GEZ 2023. GEZ 2023 is Eurodollars futures, and they're expiring in December of 2023. These are expiring. The white is expiring in December of 2022. So these are a year away. 95.32. That's roughly a 4.7% Eurodollar yield. So 4.7%. Okay. In comparison, we can also do this on the Fed funds, because what we were looking at is the Fed funds. We weren't looking at Eurodollar, and Eurodollar is just a small step above, but it's really not too much. It's just another interest rate. So and the reason why I care about these interest rates is because the interest rate is just basically a risk-free rate. I'm just trying to derive a risk-free rate, and when you have that risk-free rate, which some people say it's the overnight Fed funds, which is pretty much risk-free, which is another funny joke in finance, that there's a risk-free rate. The reason why you're getting paid is to assume some risk. But anyway, that the reason why I'm looking at these two charts right here that look so crazy is the ZQ, which is a 30-day Fed funds future, and the GE, which is the Eurodollar future, is because I'm trying to look at where yields are going to go. Are yields going to go higher? If yields are going to go higher and significantly, and the whole market's saying, okay, yields are going higher, then maybe I should. It's just another frame of reference. It's not going to say, hey, short here, short right now. That's what I have these for. That's what I have HVP for. Is saying, okay, now so now you can kind of see how building in with this kind of central bank monetary type of framework of, okay, so now you're getting this information in from these outside sources. That's not BApig. So I would, number one, put a bit red flag when it's not BApig. Definitely say, okay, is this legit or not? Maybe ask somebody, or you can kind of get a feel for when things are not legit. But we're getting this information in, and realistically, all you're trying to do is just help to as an input into your decision making. Okay, I see that the mean is positive here, or I see the mean is negative. Should I go short some crude here? And even in that, you can kind of see how I'm already trying to make flawed decisions, because if the indicators are telling you that the short is here, then the whole narrative behind it is probably just going to mess me up. It's probably just going to make things a little bit more complicated than they need to be. But like for that whole narrative, it's just kind of like the icing on the cake. It's nothing that's like the main. If you're trading off of words and what people are saying and stuff like that, then you're just not going to make it in 2022, unless you got some black edge, you got some dark kind of you got some insider information, as they say. Black edge would be insider information, but. Anyway, yeah. So when we're making decisions, we're going off the charts, we're going off the numbers. But with that, we can use that in combination with market dynamics, and put that in. But at the end of the day, it's all buying, it's all selling. That's all that's going to move this price. Not the fact that somebody said that we're going to have a recession or whatever. But all right, so. Thinking about where we can kind of go from here. So I would kind of get into building a chart setup, but that might be a little bit too much. But from the viewers on right now, is there anything that you're kind of like wondering? Maybe I can just. Oh yeah. So I was. Why do I have these two charts up, right? And the ZQ, which is your 30-day Fed funds futures, and your GE, which is your Eurodollar futures. The reason why I have those up is because I'm looking for interest rates. Where are interest rates going to go? Why do I care about interest rates? I don't. I don't really care about interest rates all that much, but it does help kind of fit in with the mainstream narrative of interest rates higher, risk assets lower, which is more of a there are some correlations in finance that are pretty big. You got the U.S. Treasury bills being risk free. That's pretty strong correlation that people like to throw around, and interest rates and risk assets, that's definitely another one where people like to throw that around to say, oh, when the risk-free rate is rising, when those interest rates start rising, that's when you start seeing your S&P, your NASDAQ, your shares of Apple, your Bitcoins, your AMC shares, your GME shares, anything that has risk, anything that doesn't earn a fixed income, something that doesn't earn something that can be reliably accounted for, then you're going to see those future cash flows get discounted due to the increasing in the risk-free rate. Yes, that's definitely what we've seen. Yeah, there's, but How much so? How much so? That's a part where we can kind of use some BApig mathematics, and we can say, okay, how much does this relate to the NASDAQ, right? So this would be if this is going. So these should be. So 0.3 information adjusted correlation is not that good of a correlation anyway, but yeah, that is one that is. I mean, let's see this in comparison to Eurodollar futures. These should be pretty well. 0.16 mutual information. 0.7 information adjusted correlation. So when people say, oh, how do you use mutual information and to derive correlations and stuff like that, I would say look at normalized mutual information. Anything above like 0.1 should definitely be noted. Even 0.05 is still very low. You're still only displaying about 5% of the other variable. But you look at the information adjusted correlation. You see a 0.7, so saying, okay, with Eurodollars, they're pretty much they're pretty much correlated, and that's information adjusted. And then the information adjusted beta is really cool. So that means that when 30-day Fed funds futures move up by 1%, when GE moves up by 1%, ZQ will move up by 0.47%. And then we can also put it in over here, mutual information. That beta is a very cool feature because you can kind of you can kind of use beta to say, okay, this investment, but I don't know how much realistically you kind of want to have equivalent deltas, but that'll be a discussion for another day. So we can go over here and we can say, okay, let me see ZQ. And ZQ is about 1.06. So that's that. So seeing that 1.06, meaning that when there's volatility in Fed funds futures, i.e. ZQ, then there'll be volatility of about 1.06, so 1.06% for every 1% move in ZQ futures. Which would be useful for trading. It'd be useful for, okay, so if I'm trading this and this has more vol than ZQ, then if this has more vol, then maybe I should match that with my position size. So maybe with your position sizing, you could say, okay, well, I'll only put on one of these and I'll put on two of the ZQs just because the ZQ has a smaller has a lower volatility or beta. But yeah, so then looking over here, saying, okay, because when I was thinking, when I was much more of a noob, I'm still a noob, but I'm starting to get some more advanced kind of methods into my repertoire or anything, but whatever. But when I was a real noob, I thought that on days like today, you could pretty much just sell yields. You could sell bonds and pretty much print money. You could sell the NASDAQ and pretty much print money. But what I didn't understand is that the market has these expectations already put into place. So all that has to happen is the actual thing, like the actual interest rate increase to happen. Like today, the Fed funds, they voted on it. So then I don't know if it's tomorrow or at the end of the month that they're going to make it so that overnight rate, which people were paying 2.75%, now they're paying 3.25%. That rate, I pretty much used to think that, oh, well, you could just blindly sell the NASDAQ. Well, the fact that the NASDAQ's down 1.8% isn't just due to interest rates. It's not. it's due to the buying and selling of triple Q shares. That's what it's really due to. And the rationale or whatever, it doesn't really matter. But what I didn't really understand is the futures markets and how the futures markets price in moves like that, and how they're always moving, and being able to have a pulse on those markets and say, okay, well, this inversion's happening. Like we saw yield curve inversion back in Vlad's videos, calculating wealth's videos. We saw yield curve inversion. Like, it's not going to say, okay, short here, but then once you have that, oh, well, the yield curve's inverted. Well, we have contango in the crude oil futures. So these things that we're paying attention to, well, what are those monikers of? Are those monikers of a strong economy? Are those monikers of a weak economy? Are those, and so then you can start to say, okay, well, the mean's looking negative here. We've got low volatility, and we've got central bank policy that's hawkish. Sign me up for a short, So having that type of perspective, and that's what I want to be able to extend out to you guys, and also for you guys to extend over to me, things that you guys look at, and continue to learn and grow, and become less noobs. But we want to have some type of middle ground between being a noob and being a financial prick. So I'll try to be less of a financial prick and try to keep with that noob hat on. Anyway, always trying to learn here. BApig, random walk with BApig, all that good stuff. BApig live. But so realistically, what I was saying is, okay, so the reason why I have all these added symbols over on the Eurodollars piece is I'm looking for when are yields going to start falling? When is that risk-free rate going to start falling? Because once that risk-free rate starts falling, well, I can go back to those quasi financial axioms or correlations where I can say, okay, well, yields are falling now. Risk-free rate is going down. Risk-free rate is decreasing. And being able to put that in and say, okay, well, if the risk-free rate is decreasing, then investors are going to have to go out and search for some yields. They're going to have to go out and say, oh, I can't just sit fat and happy on this U.S. Treasury yield curve. I need to go out and I need to get some yields. I don't know how true that is. I really don't. Because big money, they're pretty risk adverse. So I don't know how true it is that the Fed funds, the risk-free rate is going down. So AMC is going to go up. There's so many more factors that it's not just attributable to that. But for some more macro type of thinking is that, oh, well, I can go and I can check out. I can see, oh, maybe they're thinking that yields are going to start falling in 2023, Maybe they're thinking that yields are going to start falling in June of 2023. That's the June of 2023 Eurodollar future. And it's saying 95.22. Well, this is the 95.33. So this is saying that roughly 10 basis points lower. So we're roughly saying that we're going to be at like 4.8% in June of 2023. Well, that's pretty eye-opening just right there. Though, just those two lines right there is pretty amazing, because I mean, you saw today. This is a big. I mean, this is legit. I mean, this is also last Monday or whatever. But I mean, that's a 1%. That's a dollar. That's a dollar move down lower. I mean, that's a 1% move. So now we're going to say over the next year and a half, we're going to be down to a tenth of a percentage point. That's showing that they're not looking for a lot more rate hikes. They're not looking for a bunch more rate hikes out of the Fed, even though the press conference seemed really bearish, and I know that they're saying like a 4.6% median dot, but numbers over opinions, numbers over words all day long in trading, all day long. and really in life too, but numbers over words, definitely. So that's what we'll title. We'll leave it at over here. Let me double check that I'm not leaving anybody on red. When Moon from Henry Hack. When Moon. We could see here. We could see when Moon. Maybe June of 2023. If there's no rate hikes going on there. And then there's also this tool right over here. Where you can just pull this up, and this is the futures curve right here, forward curve. So price lower, that means yield higher, and then something in February 2023, meaning that the yields actually going lower there. When that price goes higher, well, that means yields lower. So then they're saying, okay, June 2023 looks like we'll have a yield about that 4.8%. And then going up here, 95.39. So they're looking at like September 2023 for your risk-on movement, all the way out to 2026. So like 3 years. So that's interesting. So we'll keep tabs on that, and we'll use that to just kind of set a border around our thought process. And it's a good border to have of just saying, okay, is policy accommodative or restrictive? I don't know how much of an impact it really does have on equity markets or cryptocurrency markets. It seems like there's been a big impact this year, but that could also be to a variety of. But it doesn't even matter. It's buying and selling. This helps put a border around it and say, okay, well, it seems like this. But the border, I'm still not even really trusting that much. I wanna see numbers. I wanna see things that I can actually bet on. And right here, I can show you this right here. So while we have a bunch of stuff like that, which is great. Right here, volatility contraction, volatility expansion. Going from this moment right here when NASDAQ was trading at 12,055, and then going from this moment over here where NASDAQ is trading at 11,670, we've taken a pretty large decrease in returns there. But that's something that's more actionable than what the future of interest rate or whatever is going on. But there's a lot of information about the fixed income market. So I'll definitely be combing through that, and we can do that together live and work together and really become more financially literate and be able to make some P&L here, earn some yield. We'll get going with that too. But another great day with everything that's going on, and we're going to keep up the consistency, and we're actually going to increase the consistency, and we're going to increase hopefully some of the quality too. And till next time, guys. This is Dog, a random walk with BApig. Much appreciated, and reach out, and we'll keep this community growing.